Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Brianne Gardner, Senior Wealth and Portfolio Manager at Velocity Investment Partners. Raymond James is our guest co-host. Then, in 30 minutes, Alex Gracino, Global Chief Economist at Manulife Wealth and Asset Management, will be here to help us break down the latest U.S. inflation data. And, of course, we want to hear from you. First call, that's when we'll hear from you. Call us with your questions, and we'll have Brianne answer as many of them as she can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And, of course, our email address is firstcall@bellmedia.ca. Now, some of the stories we're following for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney is meeting with coastal First Nations in British Columbia today to discuss major projects. The president of the coastal First Nations has said there is no support among the group for a pipeline or the suspension of the oil tanker moratorium. This comes ahead of Carney's departure for China, where he aims to boost engagement on trade, energy, agriculture, and international security. J.P. Morgan's fourth quarter adjusted revenue met estimates. That's despite investment banking fees unexpectedly falling. The biggest U.S. bank generated more than $2 billion U.S. from the business in the last 3 months of 2025, down 5% from a year earlier. And now our top line story. Prime Minister Mark Carney is heading to China today for more on what Canadians can expect as the country looks to diversify trade. CTV's Abigail Beeman has this.
Expect progress on so-called irritants, say Canadian government sources, but not an elimination of tariffs. Canada has been hammered by tariffs on canola, pork, and seafood, which China levied in response to Canadian duties on Chinese EVs.
Canola seeds need to be planted, right? So for our farmers, it would be good to know what's going to happen.
Government officials not specific on what progress to expect, billing the trip as important in the long game as Canada works to diversify trade.
To signal willingness to talk about EVs, it's a good ask to ask for suspension of tariffs, I think, absolutely. And potentially talk about other things, about oil.
Officials describe legwork ahead of the trip as extensive. Former Prime Minister Jean Chrétien was in Beijing last week. The Prime Minister's parliamentary secretary and Deputy Minister of Foreign Affairs visited last month.
This has been a building block process. I'm confident there will be outcomes and deliverables.
Cody Blois will be back for this trip. Carney also bringing 5 ministers and newly Liberal floor crosser Michael Mah. Saskatchewan's premier, on the front lines of the anti-canola tariff push, will join the Prime Minister for a few meetings.
Pragmatic engagement is fine. Diplomatic amnesia would be a mistake.
Canadian officials concede there will always be areas where Canada and China can work together and others we cannot. A coalition of human rights groups issued a letter to Mark Carney ahead of the trip.
We urged the Prime Minister to take a stronger stance than in the past with the human rights situation in China and Hong Kong, and as well as warning China not to mess with our internal affairs, meaning the foreign interference.
The Prime Minister leaves for Beijing Tuesday. After China, he heads to Qatar for a bilateral visit focused on trade, followed by the World Economic Forum in Davos, Switzerland.
And that was CTV's Abigail Beeman. Let's bring in our guest co-host, Brianne Gardner, Senior Wealth and Portfolio Manager at Velocity Investment Partners at Raymond James. Brianne, thanks as always for joining us. Nice to see you in studio.
Yeah, thanks for having me as always.
Thank you for coming over. And you had to drive down. You came down from up north in the snow and everything. Busy week for the Prime Minister. China. He has a visit today out to the West Coast to talk to Indigenous groups, and then Switzerland after that. But China is the main focus. What do you think we'll see from this?
Yeah, I think we're seeing Mark Carney's visit to China. We're looking at where that was. I know we were discussing before too briefly via Prince Rupert. That does really send a clear signal for Canadians. I think Canada is rethinking how and where it engages in global trade. And I don't think that Prince Rupert was by no reason a coincidence that they chose there. Prince Rupert
That's for the meeting with the Indigenous First Nations groups. Yeah.
Yes, exactly. Prince Rupert is Canada's direct shipping route to Asia, right? So fewer days at sea, lower costs, less congestion in the U.S. coast, West Coast ports. So it does really highlight Canada's West Coast advantage at a time when almost global supply chains are being rewritten. So it will be an interesting conversations to see how they are developing, what those doors do open for Canada and for our energy sector as a whole.
And he's got kind of going with a show of force. He has 5 cabinet ministers with him. And Scott Moe, the Premier of Saskatchewan, is joining for a leg of the trip to China. Do you think we'll see anything from this?
I think this is really a step forward for Canada and for the country. You know, trade diversification is really no longer optional, especially for us. I believe that Canada remains heavily, and we are seeing that, dependent, at least right now, on the U.S. for exports and the amount that we do export in the energy and oil sector, especially. I think if we do strengthen our Asian trade links, isn't about necessarily choosing sides. It's about reducing our risk and increasing resilience for Canadians and for Canada as a country. So energy exports do remain almost the elephant in the room, and Asia is one of the fastest growing energy demand regions in the world. So for us to get, in the door, have that opportunity, I think it would be great, and also improve Canada's investment credibility, right? And as well as reducing our concentration risk on how much we do export to the U.S. by having other trading partners as well.
And how will the markets look at this, do you think, especially energy? Is there reason for optimism, or are they just taking a wait-and-see approach?
Yeah, I think China would, if this, does pan out, would become, a customer, not a partner necessarily of values, but Canada can engage economically while still remaining, I think, clear-eyed geopolitical. And there's definitely a lot of geopolitical risks still out there. I do think for Canadians and for investors, this could potentially expand our partners, reduce our concentration risk in the U.S. export, while potentially there could be a potential upside for the Canadian dollars for investors to take aware of. I do see some short-term volatility anytime there is any geopolitical risk or noise that would create a little bit of short-term, but that could create long-term benefits. And I do think Canadian energy is still a major sector in the TSX, right? It makes up around 15 to 20% of the TSX, so still a heavyweight there.
And in some ways, really, this meeting with the Coastal First Nations is almost more important, because that's where the oil has to get through. It has to either we have put another pipeline, or we have to get the tankers through. And they've been vehemently against it. So in some ways, this meeting is more important.
Yeah, I do think, looking through more of an investment lens, yes, the Prince Rupert and increased trade potentially through Prince Rupert would benefit the rails, the ports, logistics, infrastructure, and energy adjacent industries as well. So it's not just one thing that it's opening. It is opening, expanding a lot of opportunity for Canadian and for our industry. I think longer term capital does tend to then also follow where investments are and follow policy clarity and that export certainty that we could have. So it could, again, it's a little bit of a wait and see right now. I think that is positive momentum for Canada and for our energy sector.
All right, some big meetings. We'll wrap it up there for now, Brienne, but we've lots more to talk about when we come back. But first up, we'll take a look at the markets before the bell. See how things are shaping up on the markets. We start with U.S. futures, and right now investors are cautious as they await the U.S. inflation numbers. You can see the Dow is off by 0.2, NASDAQ the same, and the S&P 500 off by 0.12. Over in Asia, look at some of those numbers. The Nikkei, possible snap election in Japan had market there jumping. It was up more than 3%. Hang Seng also up by 0.9. SSI 300 down by 0.6. Heading to Europe, it's pretty much a wash there, except for the CAC 40. You can see it's off by 0.3%, but the FTSE unchanged. German DAX virtually unchanged. Investors there also awaiting those U.S. inflation numbers coming up in about 20 minutes. Let's take a look at where the TSX finished the day yesterday. Well, we started the year with the TSX eyeing 31,000. Now it's looking, or 32,000, I should say. Now it's looking at 33,000. It hit record intraday and closing highs yesterday. And some of the winners and losers, gold and silver jumped 12%. Curaleaf Holdings, cannabis, 8%. On the downside, not too much of a downside. Exchange Income off by 2.2 and Emera off by 2.4. And looking at gold and silver, it is, silver just jumped again. When I looked about half an hour ago, it was down. It's now up. It was up above $87 right now. Record highs, up more than 2% today. Gold is off slightly. It's a wash, but still well above 4,600 right now. And copper also pushing into record territory. It's above $6. Western Canadian Select jumped nearly 2% yesterday to push that $45 mark. Just below it right now. Concerns over Iranian exports dropping gave it the lift. And WTI bouncing back as well, up well over $60 a barrel. It's been a while since we saw it there this year, or in the last year, but it's up above 60, up 1.83% in early morning trade. Well, global central bankers threw their support behind Fed Chair Jerome Powell after the Trump administration ratcheted up its already unprecedented pressure campaign against the Federal Reserve. For more on this and this developing story, we'll bring back our guest co-host, Brianne Gardner, Senior Wealth and Portfolio Manager at Velocity Investment Partners, Raymond James. Brianne, your thoughts on this? I mean, have you ever, I don't think I've ever heard or seen this, where they all come together. Usually they're very apolitical. They just want to do their job. But boy, oh boy, to hear them all voicing almost a unanimous consensus on it.
Yeah, I think there can be some concerns if the Fed is, not kept separate from everything else. And we have seen, former Fed chairs as well, Alan Greenspan and Janet Yellen, both come forward and also agree that they believe in this independence. And it is very important to keep that separate of, what is happening with the economy and how to run the U.S. separate from, the political views and noise and sometimes where the president wants things to go. So I think there needs to be that strong divide so things aren't swayed to potentially, also coming into a midterm year. We want to make sure that there are no swaying of how to run and manage interest rate decisions, policy decisions, and also maintain that credibility of the Fed chair as well.
And it's an interesting time because he's stepping down shortly, and it looks like it will be a Trump supporter or Trump fan that will come in after him. We're not sure who yet. He said he has some ideas, but who knows what will happen with that. Why do you think go after it? What kind of an impact does it have on the markets when he's doing this?
Yeah, I think right now, as you mentioned, it likely is, 4.5 months till we see Powell step aside. So looking at around May. But at that point, as you also mentioned, we are going to see someone that is likely going to come in that favors Trump. And the thing about Powell is he always has been data driven on the path of interest rates going forward, been very strategic, pausing. We had even a divergence from Canadian cutting interest rates to the U.S. We did a lot more cuts in 2025 and 2024 on the back than the U.S. had done. And, he has always vocalized it is dependent on the data. Inflation has continued to cool out of the U.S., not hit that Fed target at 2% that they have always voiced that they want to hit. I always said that had to kind of be a range. It is a bit of a moving target. But again, that is how Powell has been managing expectations of the direction of interest rates. So for me, yes, I think having someone that is, whether in Trump's back pocket or heavily swayed by political noise, I do think that we will likely see more interest rate cuts than if Powell were to stay in office. I think this new replacement will likely have additional cuts. Trump wants strong U.S. economy, more jobs, strong stock market, all help to boost, again, in midterm elections. And he wants a growing U.S. economy. He's all about making the American better again, right? And so for him, the bottom line, if interest rates are going down, more money in people's pockets, lower borrowing costs, the stock market's going higher.
But there are some dangers with that if the drops don't make sense.
Exactly, 100%.
Which can end up costing people more money, right?
Yeah, and I think, even flip side, Canada has done a great job at pausing, strategically cutting more. So we did, potentially sidestep a recession. We saw, weak economic data continued to get weaker, weak GDP numbers out of Canada, job numbers as well. And so we did diverge from the U.S. and make additional cuts to sustain our own economy. And I think that was a great job by Bank of Canada. And we have been able to kind of weather that storm a little bit. Not great, but we could have gone into a deep recession if we did not make additional cuts out of Canada. So I think that was a strategic decision from the Bank of Canada. Whereas now, yes, if you still have a booming economy, the U.S. consumer is still outspending, there's still jobs, corporate profitabilities are hitting double-digit growth, and you're cutting interest rates more aggressively. When things do turn, you're losing the leverage that you do have to be able to help the U.S. economy when that's like your last ticket of strategy in your pocket.
Now, what do you think the markets are thinking up here with Macklem? Because he said the Fed chair reflects the very best in public service and has his full support. I mean, it's kind of getting involved in politics in a way. How do you think the markets up here will look at Macklem doing that and saying that?
Yeah, I think to have the support of Canada, is positive. I think we are closely linked countries as well. We do so much trade together. We are, their little sister. We always say if the U.S. sneezes, we catch a cold. But, our housing would be impacted, consumer spending, immigration-driven demand would all be impacted by Canada as well. So I do think that Canada is benefiting indirectly from the Fed's restraint to also, at this time, not make additional interest rate cuts.
Okay.
And same thing, weaker U.S. dollar. We've seen the U.S. dollar drop drastically last year, and expectations are for, again, based on the economic data, further weakness in U.S. dollar versus at least the CAD as well.
Okay, we got to wrap it up there, but lots more ahead. We'll be back with Breanne Gardner to see why Brookfield Infrastructure is on her radar. Time to see what's on the radar for Breanne Gardner, Senior Wealth and Portfolio Manager at Velocity Investment Partners, Raymond James. And Breanne, first up, Brookfield Infrastructure. What are you liking about that right now?
Yeah, Brookfield owns infrastructure that quietly moves a meaningful share of the global activity. As you can see, it has had quite a volatility over the past year. They're up about 4%. So we do see, there's more upside in this stock. I think with a meaningful shares in global activity from energy, goods, to data traffic across 30 countries, about 85% of their cash flow comes from assets that are regulated or under long-term contracts, which for me is rewarding. And again, when these contracts continuously, they're not constantly renewing contracts. So they have that steady cash flow coming in for their business. That helps to smooth returns with markets, even when they do get choppy. One of the fastest growing areas also in digital infrastructure is Brookfield. And they benefit from the surge in data usage and data centered power demand. So again, we still think there's more upside in Brookfield, has been on our radar. We think it could, pop up to that 52 in the short term. And we do own this stock and we want to continue to hold it.
When you just going back to the contracts, what's a nice long-term contract to you?
I would say long-term, if they could even do, anywhere from 8 to 10, but sometimes some of their contracts are longer. But again, if you're not renewing even on an annual or every 2 to 3 years, where you're constantly having to go out and find additional clients or additional cash flow coming in, you I can, use this capital. I know how to allocate this capital over the next 10 years, and you can be strategic on what that looks like. And again, it's consistent, right? So bottom line is, if it's not unpredictable and they know what that time period and what it looks like, to me, that's stability in a company that I want to see. Consistent earnings growth as well, ranks at 8 out of 10 fundamentally for a must from a score perspective too.
And with the data centers, it doesn't feel like we're anywhere near done, does it?
No, I think they're just kind of ramping up and going to continue to invest and grow that area of their business. And I think too, like the infrastructure across the board is just going to continue to expand in the data center space.
Okay, let's get in Boston Scientific.
Yeah, so Boston Scientific in the financial sector there is really more focused on devices. So it has been a little bit volatile over the past year. But again, we see some upside in the stock and a little bit of a turnaround story. And healthcare sector is projected to be one of the top or overweight sectors for 2026. And we think that Boston Scientific is going to participate in that. So they have devices that are used in tens of millions of procedures globally each year, making it really deeply embedded into the healthcare system. So they have launched 10 major products over the last few weeks. So, they are a driver and continue to drive growth through innovation rather than necessarily just straight price increasing in their products, which I think is important, is that they're constantly looking at growing, constantly looking at where the healthcare sector is going and providing products to for consumers for that. And really with this aging population that is not going anywhere and the boomers retiring, care homes becoming more and more popular and overpopulated, I think that this is going to continue to push these procedure volumes higher, creating demand that largely is really independent almost from the economic cycle and from a lot of this political noise that we talked about earlier.
And they just picked up Valencia, right?
Yes, exactly.
Okay. Oh, sorry, go ahead.
No, that's all good there.
You're liking that acquisition?
Yeah, I like a few of the acquisitions they did do. And again, I think they have enough cash flow and capital on hand that they can continue to do more of these acquisitions, continue to be innovative and lead the charge in the healthcare industry. So I don't think they're going anywhere. And again, we see a double-digit upside from here in the stock.
Okay, let's get the last one in, Salesforce. What do you like about that?
Yeah, so Salesforce, I think, has been, behind the scenes, a little bit squeezed and hasn't really done much over the past year, down about 18%. So this has been one that's on our radar for a while. We don't think that they participated in this kind of AI boom, tech
They've started
rally.
to bring some in, though, right? They just made the announcements about it.
Exactly. And, we use Salesforce from a CRM perspective behind the scenes, but this business model has gone a lot farther than just, a CRM. They now support and operate for operations over 150,000 organizations, including some of the world's largest enterprises. RBC recently also integrated them into their wealth management business. So it's really a platform processing billions of customers' integration every day, making switching costs really extremely high. Once you're in their system, you kind of get locked in, which again creates that long-term consistency and determination. Okay. I think their AI tools, as you mentioned too, are being layered into their existing workflows, which does really expand their value per customer. So data is money, right? Yeah. And Salesforce is collecting all of this data, which is extremely valuable for the long run. Okay, we got to wrap it up there, but lots ahead. Alex Grissino, Global Chief Economist at Manulife Wealth and Asset Management, is up next. He'll help us break down the latest U.S. inflation data that will be coming out in just a couple of minutes. And, of course, our phone lines will open up soon for first call. You can reach us at 1-855-326-6266. You can email us at firstcall@bellmedia.ca. Delta shares are falling in the pre-market. That's after the airlines beat earnings expectations, but issued a full-year revenue guidance that fell short of analyst expectations. Delta recently made the decision to order 30 Boeing 787s, its first ever purchase of that model, the Dreamliner. Prime Minister Mark Carney is meeting with coastal First Nations in British Columbia today to discuss major projects. The president of the coastal First Nations has said there is no support among the group for a pipeline or the suspension of the oil tanker moratorium. This comes ahead of Carney's departure for China, where he aims to boost engagement on trade, energy, agriculture, and international security. McDonald's Canada is freezing the price of some of its items for a year. A small cup of coffee will be $1, and the price of the McValue meals is dropping to $5 from $6. The fast food chain says Canadians are facing challenges and are insecure financially, adding the freeze is what customers are looking for. In recent months, Tim Hortons, Wendy's, and Burger King have all introduced meal deals or small combos. And looking at the markets, the swing there, the
Dow up by 0.13, the Nasdaq up by 0.2, S&P 500 the same, up by 0.22 right now as we await the CPI earnings. They're obviously reacting to that right now because we know what they are. It came out for December, and joining us now to dive deeper into the numbers is Alex Gracino, Global Chief Economist at Manulife Wealth and Asset Management. Alex, thanks very much for joining us.
Thanks for having me.
Pretty flat. No surprises in the numbers there.
No, I think if you look at the headline figure, up 0.3% month over month, no big surprise. One slight source of upside was the 0.2% month over month. Street had been expecting 0.3%, so a little bit better at the margin. But if you look at food CPI, that's actually up 0.7% month over month, which is a problem for people who look at it from the perspective of grocery prices going up. You see that every week.
Yeah, and a quick question, how reliable do you think are these December CPI figures given the, recent data disruptions that we had, the pause? We haven't really got data out of the US in September. So I don't know if it's the month over month or maybe people or investors are going to be looking more at the year over year data to be more relevant. What are your thoughts on that?
Sure. I think it's a great point. We've gone from the delayed to the distorted data. We're still dealing with partial information at this stage, and we're running off of distorted months. So you take the data with a grain of salt and you look forward a couple more months before you actually feel like you get a clean read off of the CPI at this point. And we're really looking at the month over month prints right now just to get an impulse of where inflation is going at the margin.
Does it give you enough to kind of make an analysis of it and say, it is heading in the right direction or it's heading in the wrong direction with those numbers?
We still very much think that inflation becomes less of an issue as the year goes on. There's probably a couple of months where you see it pick up in the spring before cooling off. But one of the more interesting points really is that housing inflation seems to be well contained at this stage. A lot of the anecdotal evidence we're getting as well with rents across the country seems to be cooling as well. So if that moves down, it's a pretty powerful disinflationary force, which means that the data should be reasonably well contained.
Yeah, Alex, and I know you just mentioned talking about the housing as part of inflation and CPI figures. Is there any other sectors or stickiness in prices, broad base or concentration within CPI or key sectors driving the inflation rate this month or that you have any concerns over?
I haven't looked at the details just yet, but the general area that really does stand out is food. If that keeps climbing, it might not necessarily show up in the core metrics that you tend to associate with monetary policy, but the consumer certainly feels it because when you look at gas and energy, it's stripped up because it's volatile, but it is also the thing that a consumer sees every single week when they pay for groceries, when they pay for gas. So that would contribute to consumer anxiety.
And is that tariffs that are driving that? What's driving the food inflation?
There could be that to some extent, but it's just been an ongoing problem since the pandemic.
And showing no signs of letting up. Is the trend going either direction?
It's hard to say at this point, but we would hope to see it at least level off at some point fairly soon. You've heard the anecdotal evidence over the last several years. It was eggs, now it's beef. We'll see where it goes from here, but it's about digging into the components at this point and seeing if there's relief at this stage. One other thing that's important to note, though, is that while this number does help give you data, it won't really affect what the U.S. Federal Reserve does in late January. I think that when you look at key members of the FOMC, most notably New York President Williams yesterday, it seems like they're pretty happy to put things on pause, which means you get at least a couple more prints before you make a decision for March.
Can you see them kind of sitting pat until the handing off of power?
We do think that there's one more cut between now and late May. We think that the overall data is generally moving in the right direction to allow it. But again, it is month by month. And certainly having a couple of months of distorted data throws a monkey wrench into a clean read.
Yeah, and I think for investors right now, and obviously you know that as well, Alex, that the data can change and it is data dependent on how the economy does. And we get this backed up data to continue to see the month over month inflation CPI figures. I think there's about a 35% chance now that there's going to be a rate cut out of the U.S. I'm in alignment with you that, they might be pushed till the second half of the year a little bit more. We still expect cuts out of the U.S. And I think that should be positive for the U.S. stock market and the U.S. economy. Is there any other additional leading indicators that would suggest inflation could potentially reaccelerate in the U.S.? Or are we going to continue to project that data continue to come down closer to that 2% Fed target that they do have?
The way we're thinking about it really is that if inflation shows up in the tariff-affected areas, the Fed's effectively given those components permission to run hot, treating it as a one-off shock. We'd be much more focused on what services inflation does because that's a proxy for wage growth, and that runs into medium-term inflation expectations. The thing is, though, when you look at the labor market, there's no real evidence you're going to see sustained pressure on wages at this stage. So if the labor market starts to tighten more, that would be something we'd be concerned about, but we're a long ways from that at this point.
I just want to get in one question about vehicles. There's some interesting numbers on that, apparently.
Hang on, I haven't had a chance to look at it just yet.
I haven't either, so I'm putting you. From me being on the spot, I get to put you on the spot, Alex. Sorry about that.
Let me see if I can look at it very quickly.
1.1%. Okay, I'm just getting the numbers now. 1.1% decrease for used trucks and vehicles.
Okay.
And new vehicles were flat.
Yeah, I think that's an interesting dynamic. When you look at where vehicles have been in the United States, you're actually seeing reasonable sales for autos and cars. Looking back to earlier this month when you saw Ward's vehicle sales come out a little bit ahead of expectations. It's clearly a chunky part of the consumer basket. But if you look at used cars and trucks down 1.1%, I view that as being possibly a distortion given where prior months were. Okay, so it could just be some give up. Wait a month to see. Standard maxim in economics. 1 month does not a trend make. You have to wait 2 or 3 before you get a real read off of that.
All right, we got to wrap it up there, and thank you for finding the answer for that. We appreciate your patience on it. Alex Crisino, Global Chief Economist at Manulife Wealth and Asset Management. Still ahead, Brianne Gardner, Senior Wealth and Portfolio Manager at Velocity Investment Partners. Raymond James, she's sticking around, of course, and she's got her eye on the bond markets. We're going to talk more about that after this. And, of course, our phone lines are open. Brianne will be taking your calls. You can reach us at 1-855-326-6266. Email firstcall@bellmedia.ca. We're back now with our guest co-host, Brianne Gardner, Senior Wealth and Portfolio Manager at Velocity Investment Partners, Raymond James. And Brianne, well, let's take a look. We've got a couple of things we want to talk about. Market outlook, just in general, but also bonds and where they're going to fit in with everything that's kind of unfolding. Bigger picture for the markets right now. What's your thoughts on it?
Yeah, I think across Wall Street, you are seeing expectations pretty bullish for the year. An average return for the S&P 500 of about 9%. Our expectations are we expect the first half of the year to be quite volatile. Again, heading into midterms, not until around November, but you do tend to see volatility pick up. There's also the January effect. Depending on how January returns, then we usually, if positive, we tend to see a positive year.
Right now, it's looking like it could be a good year then.
Yeah, we have
by the start of January so far.
Yeah, we have had quite a strong start to the year, which is, again, positive. But coming off the back of 2025, which was a little bit more muted volatility than we historically have seen, we saw one correction in April. But since then, we never really got any single-digit 5+ pullbacks throughout the year. So we do expect this year to be a little bit more, at least the first half, have a few sell-offs and take advantage of that right now. We have raised a little bit of cash across our portfolios, just a little bit defensive, taking some profits along the way and looking at strategically deploying that capital when we think the timing is favorable.
And where are you looking?
Yeah, so I mean, I think right now it will be depending on if we see a full, across the board sell off or profit taking, usually into the new year too. You do tend to see people who maybe haven't taken too many profits in 2025. There wasn't a lot of tax loss selling to do. So, and looking at how many gains we had across the board, it was a great year for investors to be invested in the equity market as well. So we have some people would have had to trigger some gains maybe in 2025 and rolling some of those into 2026. So we expect to see potentially some profit taking in the first 2 months of the year. That we are still looking at, industrials for sure. Energy, I mean, we have seen some short-term rallies there with the Venezuela news coming out. We still like tech, the AI play. We don't think it's gone. I think there's certain areas and pockets of areas of opportunity with stretched valuations, but we still like tech, and we don't think that play's going anywhere. And then also, we talked about a little bit earlier on the Boston Scientific, but U.S. healthcare from a fundamental and valuations there too.
Okay, now let's bring in the bonds. They're in a bit of a weird spot, aren't they?
Yeah, we looked across the board and where people are investing capital. And even if you look back to the 60-40 portfolio, a lot of people reference that. Is really staging a little bit of a comeback. After almost years of underperformance, bonds are regaining their hedging role, really thanks to falling policy rates and more attractive real yields. However, bonds have been a little bit hated, so to say, for years, and understandably, because really markets have been strong, and any crashes or pullbacks have been really short-lived. We've seen a lot of V-shaped recoveries, right? Bond exposure in clients' portfolio is now near 2008 level lows. So we're still underweight fixed income or the bond market. However, for clients that are sitting in cash, there's over $7.4 trillion of cash on the sidelines. We had a lot of GICs mature in the last year and a half, and those investors, whether retiree or having that cash on the sidelines, the bond market isn't a horrible place to be, not just for that yields. We're still getting decent yields from our bonds, about 4 to 5%. And if we continue to see interest rates on the path that they are going down, we will see a little bit more of price appreciation on those bonds. As they do work inversely correlated. However, the upside potential you're still getting from the equities is going to outpace the bonds. But we still like bonds for diversification in a client portfolio, for risk management. And even if you think of areas where there's uncertainty or noise, 2008, people flee to bonds for safety, right? That you're still collecting that income that is consistent, even though their prices might fluctuate. One thing that was interesting was 2022, when we went into that bear market, we reduced our bond exposure quite low. This is, again, our strategic kind of more active management rather than just holding steady. We reduced our bond exposure down to about 10%. And in that time period, I mean, there was nowhere to hide except for energy was the only positive sector in that bear market. And the bonds were down about, Canadian and U.S. both bond index were down double digits, about 11 to 13%. So did that give investors a little bit, stomach their concerns of are bonds as safe as they have been in the past, when you can see double-digit drops from a safer asset class? But again, it is interest rate dependent. So if interest rates are going down, you're going to see the price of bonds. So it does really depend on where interest rates are headed. And we expect interest rates to continue to, at least this year, head down, which could be a little bit more of a boost for the bond market.
Okay. We'll leave it there. And still ahead, we're going to take a look at some of the notable analyst calls and recommendations moving the markets. BMO Capital Markets has upgraded Centerpoint Energy. We'll tell you why after this. Let's take a look at some of the notable analyst calls and recommendations for today. Centerpoint Energy and Alliant Energy are the ones that are up in pre-market trading right now after BMO Capital Markets analyst James Thalacker raised the recommendations on the utilities to outperform from market perform on growth and low risk. Thalacker notes that Centerpoint has minimal political uncertainty compared to peers and a strong rate-based visibility, writing, quote, despite its current premium, we believe CMP will outperform peers as investors look for exposure to names with visible higher growth and higher certainty in execution, adding that they expect that current capex plans are conservative and that the company could invest in grid modernization, strategic undergrounding, and expanded transmission capacity. For Alliant Energy, Thalacker sees compelling risk-reward profiles and near-term growth along with multiple expansions in 2026, writing, quote, "We believe investors should be willing to pay an increased premium for the company's quiet regulatory calendar amongst a noisy national political landscape, creating an opportunity for multiple expansions." Also noting that in a risk-on environment with AI-driven growth, the company should have earnings revisions and a higher growth profile. And let's bring Brianne Gardner back in on this. She's the Senior Wealth and Portfolio Manager at Velocity Investment Partners at Raymond James. Brianne, what do you think of those?
Yeah, I think if I'm looking at the company overall, I mean, fundamentally it still ranks to 8 out of 10. Would I pay a premium for a name right now? Probably not. You are seeing a mix between buy and hold on the street for this stock specifically, a price target, of about $72 per share.
Mm-hmm.
And so, I think for me, it's not really a stock that we do own in the portfolio. You have seen some institutional buying, though, which does show, where big money is flowing. So whether there's upside over the long run, for me, I would wait for a little bit of a pullback in the stock before if I wanted to get into it. So for me, I'd be staying away at this time just from a straight valuation. Yes, there can still be upgrades in and outperform over the long run, but where the stock is currently trading, for me, I would be a little bit patient.
Okay, and that was Centerpoint or that was Alliant?
Alliant.
Okay, and Centerpoint, same.
Centerpoint, again, not a stock that we do own. CNP, I think we believed was the ticker there. I think you're seeing a value score of about 6 out of 10 for me, again, in that holding company, which engages in the businesses of that power generation you had me briefly mentioned. Upside potential about 3% from here. So you're seeing a price target 42. I think I saw mixed signals on, yes, you're seeing BMO Capital Markets who upgraded as well to about that 42 price target and outperform, but you're seeing analysts over shifting to a hold. So for me, it would be a hold for me right now. But there is still upside from a value perspective in Centerpoint over Alliant.
Okay. All right. We'll leave it on that note there. When we come back, Brianne is the Senior Wealth and Portfolio Manager at Velocity Investment Partners, Raymond James. We'll take your questions on First Call. Time for First Call, and our first caller is Daniel from Markham. Daniel.
Hi, Roger. Hi, Brianne. Great host and one of the great guests as usual. My question is on Power Corp. Do you own Power Corp or any other life cos? And if possible, at what price would you buy at any pullbacks? Thanks for taking my call, and First Call, great show.
All right, thank you.
Yeah, thanks for the question. I don't own Power Corp, but even if I'm just looking at, has done very well, especially over the longer run. You have seen the stock kind of shoot up recently, consistently 1-year return about 70%. So that is a great return there. I think from a value score, it still ranks a 9 out of 10 for me, and fundamental 8 out of 10 has been on our watch list. And there you go, 5 years, you're looking at 146%. So, you are still having that growth story for this company in Canada, and really is a management and holding co, which engages in almost the financial services and asset based. I don't own this stock. We're in kind of the Brookfield, and some of the banks, mainly left. We have as RBC, we trimmed the rest. Right now on the street, you're seeing a little bit of mixed outperform and hold. Majority of analysts are seeing it as a hold, with a little bit has hit the price target, so a little bit overvalued. For me, I would wait seeing that short-term run up, especially even to start the year 2026 or finish 2025 to 2026. I would be a little bit patient and wait for a pullback before getting in this stock.
All right, let's move on to an email. It's from Craig, and he says, Brianne, wondering your thoughts on consumer food stocks, including Campbell's, Heinz, Hormel, and Conagra.
Yeah, so I think I do like Campbell's. They have had quite a bit of media exposure on some of their soup products in the news. So, sometimes any press can cause short-term volatility in a stock and has, as you can see, significantly gone down. Not a stock that I own, but is certainly on our radar for a turnaround story. We haven't got in yet. Again, I wait for some conviction to see how this is all going to play out with these acquisitions that have been from Campbell's. In the food sector space, consumer food stocks are shares of companies that are really producing these and continue to be consistent even when markets are volatile, right? So people are still buying discounted food pricing, even if I think of stocks that I also like a little bit more, like McDonald's. Chipotle has had quite a significant sell-off, but McDonald's has been pretty stable through market volatilities and lower cost. If we are in, tighter spending, I think McDonald's will be a stock that will continue to do well. So I do like the area. I think they are typically more an outperform in downturns versus cyclical sectors because of demand pricing. And if we are still in, momentum and growth, which we do believe we are in the business cycle, you're not going to see outperformance from these stocks. If you are looking for that, you'd have to wait, I think probably 12 to 15 months before we get into that. But you're going to get that consistency.
Puttering along, right?
Yeah, exactly.
Nice and consistent. Okay, let's get one more email in. This one's from Tony. I would like Brianne's take on TELUS for 2026.
Yeah, so TELUS, I think we have started to see a short-term rally in TELUS, so to say, especially after the downward pressure we've seen over the longer term in this stock. And I think everyone, all Canadians who do have TELUS as a core staple in their portfolio are wondering, when are we seeing this turnaround? Is it going to be now? I do see TELUS having a strong 2026. From a value score, ranks a 9 out of 10, and we see more momentum, about 17% upside from here. So I would be holding on to it.
All right, we got to wrap it up. Perfect, Brianne. Thanks as always for joining us.
Yes, thanks for having me.
We appreciate it. And that is it for us here on The Street. Thanks to Brianne Gardner, Senior Wealth and Portfolio Manager at Velocity Investment Partners, Raymond James, for joining us today. It's her birthday. I forgot to mention that off the top. Happy birthday. Show Brianne there as we get out. Andy Bell is next with the Open. The markets will open just over 30 minutes from now. Happy birthday.